Welcome back to the Lecture 4 of the Value Investing in Growing Companies. Hi, my name is Rachel, and in this lecture we will looking at how the stock market works. We have already discussed briefly about the stocks and other instruments in the previous lectures. We also talked about the methodology of Benjamin Graham, the father of value investing, and his book, The Intelligent Investor. Now let's look at how the stock market works and how you can benefit from it. The stock market is where the listed companies sell their shares to the public. If a company, for example, needs more expansion or an increase of influence in market by higher production, it needs to increase its equity. One way is by listing in stock market against some shares that can be traded by public. In short, buying these shares means you are actually buying a stake in the company itself. These stocks are sold by brokers to the investors and the public. They are represented by symbols, tickers, that are often abbreviated by the company's name. The value of the shares goes up and down depending on the company's performance, stock market sentiment regarding the company, as well as the economy of the country. The stock market is just like a regular marketplace where there is a buyer, a seller, and a product, which in this case is a stock. Just like a regular market, a buyer has a price in mind on which he wants to buy the product, and a seller has a price in mind on which he wants to sell. The price of the stock or product will go high or low depending on the demand of the stock. If an investor thinks the company is going to perform well in the future by, for example, earning higher or due to expansion, he will buy the stock. Likewise, if the investor thinks the company would not perform well in the future, he will sell the stock, or in case he is not holding the stock, he will refrain from buying it. Now let's look at how can we benefit from stock market. Warren Buffett quoted, "I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years." It means we should not time the market, rather invest for long term. The market is driven by two things: greed and fear. If there is more greed than fear in the market will go up, and if there is more fear than greed, the market will go down. Benjamin Graham termed stock market as our moody partner called Mr. Market. It depends on us how we can take advantage of his mood swings. Mr. Market works on the trilogy of optimism, pessimism, and indifference. When Mr. Market is happy about the stock market, he will give a high price and willing to buy anything at any price. This is where we should be cautious and sell when Mr. Market is happy. When Mr. Market is depressed about future prospects, he will be willing to trade at any given price. This is where we should take benefit and buy at a very low price. When Mr. Market is indifferent about market, we should be ignoring him. Warren Buffett quoted, "We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful." We should be using the same methodology in our investing principles. When the prices are high and there is more greed in the market, we should consider selling our investments. And likewise, if there is more fear in the market and prices are low, we should consider buying the stock. This brings an end to our small lecture on mechanism of how the stock market and stocks work. In the next lesson we will be looking at advantages of investing in stocks and the power of compounding interest. Till then, stay blessed and happy investing.